This is level 1 of the CFA program, the topic on derivatives, and the learning module on option replication using put call parity. I'm guessing you know that we're deep into the learning modules here in this derivatives topic. And I'm also guessing you remember that I'm a big fan of these learning modules because what they tend to do is chop the material into much more palatable parts. Some of those old-time readings were, they seem to be hundreds and hundreds of pages long, and so it was a lot thrown at the candidates. So here we have just smaller bite sizes to be able to digest it and to form a toolbox so that we can be prepared for the exam. But a couple of curious things about this particular learning module. Notice that the title includes the term put call parity, but in the previous 8 modules, there is no reference or explanation of put call parity. And in the learning module pretest, it provides you with an opportunity to use the put call parity formula before it's actually given. So I was curious about that. But the other part is that there are no end of learning module problems. So we'll have to address that at the end of this slide deck. All right, learning module 9, just 2 LOSs. So essentially what we're doing is we're going to talk about put call parity. And then once we learn put call parity, we're going to go ahead and just substitute a forward contract in for the underlying asset of the options. And so that leap from LOS 1 to LOS 2 is not that big of a deal. But let's go ahead and start with put call parity. And what I would like for you to do is take a look at the illustration we have at the bottom of this slide. Notice there's a figure who is juggling. And so, maybe it's easy to juggle with your left hand and your right hand, but then throw your foot up and try to juggle 3. And that illustration is really exactly a description of what put call parity is. So I want you to look up at the blue box. And there are 2 sides of the equal sign for the put call parity relationship. Let's go through this relatively quickly, and we'll do it again throughout this slide deck. So that S sub 0, that's the stock price. The P sub 0 is the put price. The C sub 0 is the call price. Now those 3 are related in that the put option and the call option have to be written on that particular share of stock. What's also a requirement for put call parity is that the exercise prices of the put and the call option have to be identical. And that's what that X is over there on the right-hand side of the second plus sign. So all we're doing, 1 plus R raised to the minus T, we're taking the present value of the exercise price. Now what I want to do here initially is explain to you what put call parity is. It's nothing more than a summary of the relationship between 2 portfolios. All right, so look at the left-hand side of the equal sign. If we own the share of stock and we own the put option, well, we've talked about this before. We know that that's a protective put. Some people call it portfolio insurance. Right? We own the stock, so we benefit if prices rise, and then we layer that ownership with a derivative that we benefit if prices fall. So we think of the left-hand side of the equal sign as a protective put or portfolio insurance. On the right-hand side of the equal sign, we have the call option, which of course benefits us if we own the call option when prices rise. And then what we do is we buy a risk-free bond. And that risk-free bond has a maturity value of X. It has a maturity value equal to the exercise price of the option. Now, don't really worry about an exercise price of $55 or $185. I mean, we know that most bonds mature for $1,000. But in put call parity, we allow X to be anything that we want. That bond that we're buying over there on the right-hand side is probably going to be a 0 coupon bond. It doesn't have to be, but if you throw coupons in there, it just kind of complexifies the relationship and doesn't really add any value to our understanding. So this is how I want you to think of put call parity. We have a protective put on the left-hand side, and we have what I refer to as a bonded call, so that you know you own the call option and you're buying a bond that has a maturity value that is identical to the exercise price of the option. All right, so hold off on that for just a few moments. We'll come back to that here in another slide or two, but I want you to think of it this way. Look at S sub 0. Where can we observe that thing? We can observe it on the floor of the New York Stock Exchange, right? How about the P0 and the C0? Well, we can find put prices and call prices on the options exchange. And then what about the X? If this is really the present value of a treasury security, we find that as a bond price in the credit markets. So back to this illustration at the bottom, think about what this figure is doing. He or she is juggling the stock market and the option market. And can you see me if I lean over? Can you see my feet? Can't do that. I used to be an athlete, but not anymore. So imagine my foot is up in the air. We're juggling these things. And what put-call parity tells us is that there has to be an equilibrium relationship between and among the stock market, the options market, and the credit market. And that's essentially what put-call parity is. So let's go through this slide here. What do we say in that first sentence? Establishes a relationship that allows us to price a call option derived from the prices of these other, right? We're juggling these other things. So we can say if something's happened over here in the stock market and something's happening over here in the credit market, and then something's happening here in the options market, we can find the price of a call option. We can derive it based on those relationships. Now, of course, like many things in finance, we have to assume some no arbitrage relationship. And I always tell my students this. Look, if there are arbitrage opportunities that are consistently available and sustainable, then some individual or organization is out there consistently and sustainably losing money. So in this free enterprise system, there are probably not too many people out there who are always going to lose no matter what happens. Those people who lose, they make adjustments. And so they adjust so much that the price either goes up or down, or interest rates go up or down. And it forces these three markets, stock market, options market, and the credit market, to be in equilibrium. And that's what that no arbitrage relationship means. Now, of course, we can't worry about American style options here. These are just European style options. And notice what we say there. I already said that. Same exercise price and the same expiration date. Although I'm not sure I said that earlier. So let me just emphasize that. So the put and the call have to have the same expiration date, and they have to match the maturity date of the bond. That makes perfect sense. Now, we don't worry about the expiration date or the maturity date or the tenor of the share of stock, because we assume that we could hold on that thing for the rest of our lives, or at least until the earth collapses into a black hole and it gets sucked into some gravitational field signifying the end of time. Notice I know nothing about science. All right, so let's go ahead and explain put-call parity by showing the derivation of, here, let me just go back quickly, the derivation of the left-hand side of the equal sign and the right-hand side of the equal sign. All right, so let's go ahead and consider two portfolios. We have portfolio A and portfolio B. What we're going to do in the green portfolio A, we're going to start on the right-hand side of the equal sign. We're going to buy the call option. So let me go back here real quick. We're going to buy the call option. So there's C sub 0. And we're going to buy a risk-free bond that matures at X. And notice the time in there, the lowercase t's and the uppercase t's, they have to equal each other. All right, so portfolio A, what are we doing? We're buying the bond and we're buying the call. So what did I refer to that earlier? I know I referred to it as a bonded call. Now, the reading is going to call it something else here in just a second, and you'll see that. Now, let's go ahead and look at portfolio B. This is the left-hand side of the equal sign. We're going to buy the underlying stock price, and we're going to buy a put option, and the lowercase and uppercase t's have to be identical. So portfolio A and portfolio B, this is what I was saying. Oh, let me go all the way back. This is what I was saying at the very beginning of this slide deck. Consider the stock and the put as one portfolio. Consider the call and the bond as another portfolio. All right, so skip down to the bottom with portfolio A. What did I call it? A bonded call. The learning module calls it a fiduciary call strategy. For portfolio B, well, there's the protective put. So, you guys can remember it however you want. But I would remember fiduciary call, bonded call. Think about those as identical. Now, here's a terrific table that shows you that the difference between the protective put and the fiduciary call is 0 at the end of the portfolio value. So I want to skip down to the arrow point, and let's go ahead and read this together. Since the two strategies, right, the protective put and the fiduciary call, have the same payoffs, they must have the same initial value or the same acquisition cost based on non-arbitrage conditions. And so this is what happens here. No matter what the value of the underlying asset is at the expiration date of the option, whether you own the protective put or the fiduciary call, you're going to have the same payoffs. All right, so let's go through the blue and the red box here as quickly as we can. Notice across the top, we have different stock prices. So let's suppose that at expiration, the stock price is less than the exercise price. Let's suppose that they're equal, that's the middle column, and then let's suppose just the other side, where the stock price is greater than the exercise price. And of course, you should know this intuitively based on our previous learning modules, that if the stock price is less than the exercise price, then the put becomes valuable, and that's why we have the put is exercised up there. On the other hand, if the stock price is greater than the exercise price at expiration, then the call is exercised. That's why we have that at the top of that third column there. So all we're going to do here is figure out what are the payoffs under both of these portfolios. So let's look at the blue. So if the stock price, doesn't matter what the stock price is, right? Read across the underlying asset. The stock price is whatever the stock price, right? You own the stock, so if it's worth 10, it's worth 10. If it's worth 100, it's worth 100. If it's worth 200, it's worth 200, right? But now, skip down to the put option. The put option, if the stock price has fallen below the exercise price, it has value. It's whatever the difference between that exercise price and the stock price is. So if you sum that column, if you take an S sub t, plus x minus an s sub t, well, you get the x right there, all right? How about if they are equal to each other? Stock price equals the exercise price at expiration, which of course hardly ever happens. Well, what do you know? The put option is worth 0, the stock is worth whatever it's worth, and so the total s sub t plus 0 equals S sub t. Notice in parentheses, we also happen to say it also equals the exercise price. Now, if the call is exercised over here with the protective put, we don't own the call, we own the put, right? So stock price plus 0 is the stock price at the expiration date. So look at the totals there under that. Was that the third row? We have X, and then ST, and then ST. All right, you ready for this? So let's skip down to the red box. Now we own the fiduciary call, so we own the call option, and we own the risk-free bond. So if the stock price is lower than the exercise price, the call is 0. Even at the money, it's 0. But if the stock price is greater than the exercise price, then the call has value, and it's going to be S sub t minus X. How about the risk-free asset? Well, we know that it's a risk-free asset, so if it matures for the exercise price, say it's $100, well, then it's X and X and X. It doesn't matter what that stock price is at expiration. And then if you add 0 plus X, you get X. If you add 0 plus X, you get X, which is also equal to the stock price, right? And if you add ST minus X plus X, you get ST. So look at the total row and look at the total row. You have two total rows that are identical. So that's what this last arrow point tells us, that if the two strategies have the same payoff, then they must have the same price today. And this leads us, and I'm going to go back here just quickly here. This leads us back to put call parity, in that there has to be equilibrium between and among those three markets. the stock market, the option market, and the credit market. And that's why we have that equal sign right there. This is probably a good idea for you to get your phone out, take a picture of this slide before we move on. Once again, in the blue box is our put-call parity equation. And we can do a little bit of algebra. I'm not even sure this is algebra. Maybe it's kindergarten math. All we're going to do is take something to the other side, add it or subtract it to both sides. So what does put-call parity tell us? So skip down to where you read call option premium. So all we're doing is taking the present value of the exercise price and moving it over to the other side of the equal sign. So what are we saying? That the call option premium, according to put-call parity, and all of the conditions that we just described over those last few slides, has to be equal to owning the put option, owning the share of stock, and shorting the risk-free security. This is known as a synthetic call because we are replicating the payoffs of a call option by owning a put, owning the underlying asset, share of stock, and shorting the risk-free bond. So I would make certain that I would know that term, the synthetic call. When you hear that term, automatically think of put-call parity. Now, if you think you might be confused about which side goes which side, let me eliminate all of that confusion for you now. Skip up to the blue box. You ready? S&P, right? S&P 500, you always know that. So S&P, they go on the left-hand side of the equal sign, and then the bonded call, C plus X, goes on the right-hand side. So if you remember that S&P, stock and the put, goes on the left-hand side, you can't forget what goes on the right-hand side. Now you can also do some more rearranging to go ahead and come up with a put option premium, and this is going to be known as a synthetic put. So what are we doing? We're going to own the call option, we're going to short the underlying share of stock, and then we're going to buy the risk-free bond. So synthetic calls and synthetic puts. You ought to know the definition, you ought to know that equation, but that equation is easily derived if you remember my little S&P trick. So as always, we try to take you through an example to bring the academic theory behind put-call parity and all the other topics that we talk about to a better and more clear picture to help you answer these questions on the exam. All right. Million shares, $150 a share. We're predicting a bear market. Plans to buy a 6-month put option with an exercise price of $130. So essentially, we own the shares. We're buying the put option, so that's a protective put. And what happens with that protective put, and you should remember this from an earlier learning module, is that you're essentially putting a floor on the value of the portfolio, in this case at $130. So no matter what happens to the stock price, you're going to have at least $130 on the expiration date of the contract, of the put. There's also a call option on the stock with an exercise price of $130, right? So the put and the call, they both have the same exercise price. They both they both expire in 6 months. 6 months. Call is priced at $25. What is the put-call parity price if the risk-free rate of interest is 3%? So this is super easy calculation here, right? So we're just going to use our put-call parity formula, throw the 150 over to the other side, make sure we perform our present value calculations correctly. So at 6 months, we'll raise it to the minus 1/2 to do present value. So if you do all that math, you get, what is that, about $23. That is the put-call parity price of the put option. Oftentimes it's referred to as the put premium. And it's based on the fact that, I'm not going to go back in my slide deck to that figure that was juggling the stock market, juggling the options market, and juggling the credit market. And so this is an equilibrium price. Think of it as a fair price. It's the price that equilibrates. Is that a word? That equilibrates those three markets. And it leads to, you guys going to follow along with me? It leads to the no arbitrage condition. Now, the learning module turns to an application of put-call parity, which is really, really cool. This is actually a component of the corporate finance learning module, but it's a great place to introduce this. And so I want to give you an example, and bear with me here. It might take me a minute or two to work through this example, but as I complete this example, and then we're going to go through, here, let me just show you a bunch of these slides here that are coming up. These slides, which may look a little daunting now, are going to be super, super easy. All right, so you ready for this? So let's suppose that I'm Jim, and I have a backyard and have some land, and I bought the land, it's mine, and I'm a hard worker. I'm ready to have with my shovel and my fertilizer. And what I want to do is I want to plant a Honeycrisp apple tree in my backyard. And so I don't have the money to buy that Honeycrisp apple tree. I have the land and the shovel and the fertilizer and the water and whatever else I need. So I come to you and I say, hey, will you lend me a bunch of money so I can buy a Honeycrisp apple tree? And let's suppose that it's, just to make things up, that it's going to bloom this year. So I'm not sure exactly how we're going to do this. And so you say, sure, I'll go ahead and lend you, let's just pick a number. Say it's $100. So you lend me $100 and I go out and we sign a contract, right? This is a bond issue. I'm going to pay you 10%. So I'm going to pay you $110 a year from now, let's say, on your $100 zero coupon bond. So I take your 100 and I go and I buy this tree and I plant it in the backyard. And during the course of the year, I go ahead and I work at it. I water it, I fertilize it, I prune it, I do all that kind of stuff. Now I'm the owner of the land and the tree. You just have lent me the money through a bond issue. All right, so what happens at the end of the year? And let's just say, for kicks and giggles, that the tree, it produces fruit by the end of the year. So let's take two extreme examples. So let's suppose that there are thousands of juicy Honeycrisp apples. And I pick them a year from now when your bond matures, and I go sell them at the market. And I mean, these things are big and juicy. I'm selling for $5 or $10 or something like this. So I'm making tons and tons of money, right? So what do? I take all those operating cash flow, and let's suppose those operating cash flows from the sale of my Honeycrisp apples is $1,000. So what do? I take that $1,000 and I pay you your $110. I say, thanks for that leverage. I promised you 10%. Here's your 10%. Have a nice day. And what do I get to keep? I get to keep the other $890 for myself. All right, so far so good. Now, on the other hand, let's suppose that during the course of the year, the tree does not multiply and fruit. And let's suppose that a year from now, there are a couple apples on the tree. Some of them have worms in them. Some of them are brown. Some of them are yucky. Some of them were eaten by birds. Some of them fell to the ground. And I take the apples to the market and I get $20 for them. So what am I going to do with your loan? I owe you $110. So what happens? Well, I'm not going to pay you $110 to take ownership of this asset that's only worth, what did I say, $20, right? It's a rotten Honeycrisp apple tree. It's never going to produce any fruit. So what I do is I default on the bond issue. And I say to you, hey, come to my backyard. You can pick up the apples. You can go sell them and you get the $20. Now I lose everything, right? I'm out. So what we can do is we can take a look at my ownership position in this Honeycrisp apple tree as a description of firm value. And this is the heading, modeling firm value. All right, you ready for this? So this is how it works, that my ownership in the Honeycrisp apple company works just like a call option on that Honeycrisp apple tree. What do? I exercise my option, If the value of the underlying asset, in this case the tree, is, what did I say earlier, $1,000, but even if it's $500 or $400, or even if it's only $120, I'm going to exercise my option, take the cash flows, and pay you your $110. And then I have full ownership of that underlying asset. I have full ownership of that Honeycrisp apple tree. On the other hand, if the tree is only worth $30 or $20 or $10, or even if it's $0, what do? I default on the loan. And I say to you as the bondholder, you take over. So this is just like bankruptcy. This is just like Procter & Gamble and Johnson & Johnson. The shareholders of a firm, they view their equity position in a levered firm as a call option. And that's what we're doing down here at the very bottom. The market value of the firm is the sum of the equity plus the present value of the debt. Now let's go ahead and let's work through this simple example here, which is just with my Honeycrisp apple tree. So if the firm, let's do the 01 there in the green. If the firm is solvent, right, the value of my Honeycrisp apple tree is, what did I say, 1,000 is greater than the 110. Well, the bondholders receive their debt in full and the shareholders receive the residual, whatever's left over. If the firm is insolvent, on the other hand, if the value of the firm, what did I say earlier, is $20 is less than the $110, well then we're going to turn the assets over to the bondholders. The shareholders receive nothing. Oh boy, this is so cool, right? So the bondholders, let's look at the payoffs down at the bottom. Bondholders have limited upside potential, right? Because all they're promised is interest in principal. What did I promise you? I promised you $100 return of principal plus $10 of interest. That was it. That's the nature of leverage. But what about the shareholders? Boy, I have unlimited potential. If the apple tree has tons and tons of beautiful red Honeycrisp apples, then I'm going to realize all of that stuff. But what happens if the firm becomes insolvent? Well, then I can only lose whatever I have invested, right? Limited downside. And this works exactly the same for all the companies that we talk about, that I've talked about in my recordings. You know, I regularly mention, companies like John Deere and Milton Hershey and Procter & Gamble. And so, think about all these product lines. These companies have lots of debt. So what do? If their product lines are successful, what do the executives do? On behalf of the shareholders, they exercise the option and they pay off the bondholders. Now, in our example, and this is important for put call parity, that it's a zero coupon bond, and these companies, of course, they all have coupon paying bonds. So it makes life just a little bit more complex, but it doesn't really add to our understanding of, boy, let's read that orange again, applying put call parity and modeling firm value. What we're trying to do here is use what we know about options to have a better and more complete understanding of what goes on inside the boardroom, what goes on with the executive leadership team, and what goes on the right-hand side of the balance sheet, bondholders and shareholders. Now, of course, we have to ask the question, what happens when we throw this modeling firm value into our put-call parity equation? Well, all we're going to do is look at the top right there. There's our underlying asset price, right? Stock price. We're just going to substitute the value of the company, right? And over for the present value of X, and we did this before, we're just going to do the present value of the debt. So this shouldn't be a surprise to you at all. So the orange and the purple, these are just examples of exactly what I have been saying over the last, how long have I been making this video? 20 minutes, 30 minutes or so. So look down at the very bottom. The call option on the firm's value is equal to the value of the firm plus a put option minus the present value of the bond. So this is what happens when you link option terminology and all the stuff that we've been talking about in level 1. And of course, we're going to continue talking about this in level 2 and in level 3 about what is and how do we compute and who gets to determine the market value of a company. I mean, we know that we can look at the market value of the equity and we can look at the market value of the debt. Heck, we can do this like that just going to Yahoo Finance. But as good financial analysts, it's up to us to determine the intrinsic value of that company. We can do market values, and that's just a sum of what everybody thinks about the company. But using a model like this enables us to find undervalued firms and overvalued firms. And of course, this is exactly what the Institute is going to ask us to do, going to ask you guys to do in level 3 when we really link this concept with the policy statement. Now, one other thing that I want to say here, and by the way, if you actually look at the learning module, this last gray box appears in just the last sentence or two. So there's really not a big emphasis on this inside of the learning module. However, I think it's a fairly cool and a great type of an exam question. So think about this put option. Now remember, in all of this stuff that we've talked about, we're assuming that the bond is risk-free. But of course, we know Milton Hershey and William Proctor and all these companies, their bonds are not default risk-free. So that put option can be seen as a credit spread above that risk-free rate, so that the bondholders are going to assume some of that default risk. Right? They know, I mean, even a company like Johnson & Johnson, which has the highest rating, I mean, there's still some small slice, right? A little sliver that it could default on its bonds. And so that put premium for Johnson & Johnson here in the context of put call parity is going to be way lower than Jim's Honeycrisp Apple company. That should make perfect sense. Now, these last two arrow points in the bottom, really, we could have conversations about this for a really long time. But what we're going to learn, and we're going to learn this in the next learning module when we do the binomial option pricing model, and then when we do the Black-Scholes-Merton option pricing model, when we do a bunch of stuff in level 2 and in level 3, is that when you view the equity of a company as a call option on the assets of the company, you consider all of the inputs that go into option pricing, which, we don't know a whole lot just yet, but I'm going to give you the end result, is the following. You ready? So that you would think that shareholders would want the executives to invest in low-risk projects, but that's not true. That's not true. What shareholders want executives to do is invest in positive net present value projects. We know that from our corporate finance discussions. We know that the shareholders want executives to invest and maintain branded product lines because they have sustainable cash flows. But then we want the executives to offshoot. This is what I always do. Offshoot those branded product lines into high-risk projects, into high-risk product lines. Here, do yourself a favor. You type in Milton Hershey and look at the product lines for Hershey Foods. You'll see tons and tons of stuff that you never knew that Milton Hershey made. And so this is what we know, and this is that first green arrow point. Shareholder value increases as the riskiness of the underlying assets increases. Now, the reading just goes about saying likelihood of insolvency, so that's not a complete picture. And then the second red arrow point illustrates the put relationship and the credit risk of the firm's debt from the bondholder's perspective. All right, that was fun for me. I hope you guys got a bunch of stuff out of this. Now, of course, what did I say earlier? There are no end of learning module problems, so you're going to have to use all of our resources to practice all of the put call parity stuff, because over the years in engaging with conversations with candidates, I have found that they tend to struggle, at least at level 1, with put call parity. And so you got to practice and practice and practice so that you get good at it. Now, during the first handful of learning modules under this derivatives topic, we went ahead and had conversations about forward contracts, right, and futures contracts and all different sorts of other kinds of contracts. So essentially what we're doing here in put call forward parity is that we're saying something like, instead of owning the share of stock like we did in those previous examples. Instead of owning the underlying asset, let's suppose we own a forward contract. So all we're going to do is substitute the present value of that forward contract. So that's to the left of the plus sign next to the price of the put option. And all we're doing is saying something like, okay, we know that we can buy a forward contract on a share of stock, and we can pay this forward price. Well, let's just take the present value. So just like the stock price is the present value, so the forward price, we need to take the present value. Yeah, so look at what we have in red and green down at the bottom. There's that fiduciary call on the right-hand side of the equal sign. And now we're going to call this the synthetic protective put, because we don't really own the share of stock. We own a derivative on that share of stock or whatever that underlying asset is. And so we can go through this same portfolio A and the same portfolio B with the exact same types of examples and inputs that we used earlier, but just look at portfolio A. All we're doing is we're buying a forward contract instead of buying the share of stock. So look at the bottom, there's that synthetic protective put strategy. There we go at the bottom. And then there's the fiduciary call strategy. That's no different than what we did before. So here's this beautiful picture and table that we took a picture of earlier. So go ahead and get your phones out and take a picture of this. And I don't think you need me to work through every one of those rows and columns, because they are identical to what we did earlier. But all we're doing, once again, is substituting a forward contract for the ownership of the asset. And so there we go. By setting the fiduciary call equal to the synthetic protective put. There we go. There's our red block for put call parity for options and forward contracts. So we can do a quick example here to end. 6-month option, $195 per share. Exercise price, $190. 6-month call option, exercise price of $190, right? So still 6 months, still same exercise price. There's the risk-free rate. Price of the put option is closest to. So we need to go ahead and compute that forward price. What were we told? Stock price was selling for $195. So let's compound it out right there in the middle. So take the $195 times 1.015, raise that to the 1/2. Once again, right, 6 months. So there's the 196. So then we can use our put call parity solution for the price of the put option and just substitute those numbers there. So we're taking the present. Notice what we're doing there. We're doing a little algebra. We're taking the difference between the 190 and the 196, and then we're taking present value of that. So that gets us the $57.59. And that takes us through this learning module. Let me just remind you, really just essentially one LOS, but then we substitute a forward contract in there. Let me go ahead and repeat myself from once or twice during this slide deck. No good problems to look at the end of this learning module. However, there are some good knowledge checks inside of the learning module. So go ahead and look at the knowledge check problems, and then go ahead and use our resources. And don't forget those mock exams as well. So thank you for studying. I think we only have one more learning module in the derivatives here. And so we'll go ahead and get that for you quickly. So have a great day and good luck studying.